if you're looking to buy a house, let's say, you know a couple more interest rates hikes are coming, and that pressure is going to be felt after those hikes. If you're looking to get in the stock market, you know that it's going to look forward 12 months roughly. If you think the worst is behind us, well, then there might be a lot of opportunity ahead. Hey guys, it's Omar Khan from Theta Trading, and I want to welcome you to another video today. Today's topic is going to be, when will the economy finally get better? It's been a rough year, a rough year, but that does not mean it won't get better. Before we do that, if I could ask you guys a big favor, if you hit that like button, if you like the videos we're creating, hit that subscribe button if you want to be part of the Theta channel and support the channel, and also hit that bell notification if you'd like to be informed of future videos. I'm trying to release 2 videos a week that are pertinent to the economy, both to real estate and to the stock market. So if you guys like them, if you have any ideas on topics, let me know. All right, so let's get into today's topic. When will the economy finally get better? All right, so what's causing the economy to perform so poorly has been inflation, okay? And because inflation has been so high, which inflation means that you guys have probably all noticed it, gas station prices are higher, grocery store, everything costs more now. Go to a restaurant, everything costs more. Everything costs more, and that is inflation, right? The definition is too much money chasing too little goods and services. This is a largely result of all the money printing that occurred during the 2020 COVID disaster that we had, both health-wise and economically. The governments around the world, in order to stabilize economies, had to print vast sums of money so that people could make ends meet, so they could pay their bills, buy their groceries, do all that stuff. If they hadn't done that, the economy may have been in much worse shape. Now, flash forward. Okay, now all that money enters the system and you have inflation happening. Inflation. Things are costing more and more and more. And because of COVID, you had something called a supply chain glut, okay? I'm going to get more into what supply chain glut is, but let's take a look first at what inflation is doing, because that's the big nasty word. Okay, I want to share a note here from Bank of America that's dated October 25th, so a couple days ago. It says here, the U.S. consumers continue to rotate away from goods to services. The process of good demand normalization is well underway. That's a good sign, all right? What that means is basically people are not buying as much stuff. They're buying more services. Think restaurants, movies, vacations, etc., etc. That's good, okay? Because supply chain only affects goods, not services. Okay. Now, this is a very interesting line. This is what is causing all the issues. We continue to think that it will be relatively easy to get inflation down from 8%, where it is currently, okay? So the things are costing more, 8% more year over year. Things to think of that. That's a lot of inflation. That's going to hurt people, especially at the lower end of the economic spectrum. So we're going to continue to get relatively easy to get inflation down from 8% or so to 4% or so, okay? Now, if it does get to 4% inflation, the stock market, would love that. Why? Because it's going to say, oh, great, that means the Federal Reserve doesn't have to increase interest rates. In fact, they may get to come down because we want to spur economic growth on. But the Federal Reserve has said that their target for inflation is 2%. So look at the last line here. However, getting close to 2% will require a recession. Now, you're asking, what are they trying to do here? Well, what they're trying to do is they're trying to make all of us poorer, right? If all of a sudden your mortgage costs that much more, the value of your house is down, your stock portfolio is getting killed, all that's happening at the same time, are you going to be going and buying stuff? Probably not, right? You may have lost your job because the economy has gotten really bad. This causes all of us to collectively be poorer. If we are poor, we're going to buy less goods and services. This lowers inflation, okay? And then the banks don't have to keep increasing interest rates, and we can get more back to a normalized economy. So the answer is, when will the economy finally get better? I think the reality is that nobody knows. But this inflation gauge, this is the gauge that is going to be the most telling of what's happening, okay? Now, wanted to talk about one thing that's really causing a problem in this inflation issue is here, okay? Now let's take a look at oil futures. This is as of October 27th, okay? So you can see inflation, it says right in the middle there, around that May-June period of 2022. CPI inflation, 9.1%. That means consumer price index, the stuff that you guys, we are buying as consumers, were 9.1% higher in the middle of May and June versus May and June of last year. So that was inflation going up. And you can see inflation going up versus the US dollar per barrel for oil. It's very correlated, okay? Obviously, when gas costs more, you're going to be buying more. You have no choice to buy it, unless you have an electric, of course. If you're going to the grocery store, the strawberries that were transported, the oranges that were transported, they're all going to be transported, at least at the end, via gas combustion delivery mechanism, i.e. semis, right? They take a lot of diesel. Diesel prices are very high. This is all inflationary. So when oil started coming down, as you can see it did here, May and June, started coming down, and it really went up, as you can see, in February, by the way, and that coincides directly with the war in the Ukraine, the very, very unfortunate war, which has caused a lot of needless suffering around the world. That is where that spike is here. February 24th was the invasion. You can see it caused a huge spike in oil. Okay, that caused more inflation. Now oil has been going down steadily since, like I said, that May-June period, and it's hovering around, high $80 a barrel. If it gets lower, 65, 70, that would be a really good spot to be in. And the reason it may do that is because if people have less money to spend, they may not take that road trip. They may not go somewhere. The economy slows down. Well, then all of a sudden, less goods are being transported, therefore less demand for diesel, etc. This could happen. We don't know yet, but this is a very good barometer as to where inflation is. Now, inflation, if it keeps going down, then all of a sudden the central banks, i.e. the U.S. Federal Reserve, the Bank of Canada, says, okay, great. We have hurt average consumer more than enough. Their house is worth a lot less. Their stock portfolios in tatters. Now they have nothing left to spend. We can finally start easing off, and we don't have to increase interest rates as much. And we saw that yesterday a little bit with the Bank of Canada. So I'm Canadian. I live here in Canada, in Toronto. And yesterday, what you had was a step down. The Bank of Canada was expected to raise interest rates 75 basis points. That means 0.75%, okay? But what they did is they only increased 50 basis points, half a percentage point. And the reason they may have done that, and it may be foretelling of what other banks around the world may do, central banks anyways, is the reason they did that is they may be thinking, we might have done a little bit too much aggressive increases here when it comes to interest rates. We may have been increasing it too much, too fast. Because in Canada, we have gone from overnight borrowing rate from 0.25% to 3.75%. That is a huge increase because people were so indebted to begin with. So that is having a tremendous effect. The Bank of Canada said, maybe we've increased interest rates too much. We can just ease off a little bit and just see how that data comes in, the inflation data. If inflation data starts coming down, and like I said, it may be foretelling of what other banks may do, the U.S. Bank, U.S. Federal Reserve, they may not increase interest rates. And the stock market, being a forward-looking mechanism, would love that. Okay? Now, the real estate pain is still going to be a little bit longer, in my opinion. Why? Because real estate's a lagging indicator. So you had a 50 basis point hike, let's say, here in Canada. All right, it's going to take some time for that to filter through the economy. All of a sudden, people are going to realize that when they're qualifying for a mortgage, it's going to cost them that much more. Therefore, the person who they're looking to buy that house from won't probably be able to get the same price they're looking for. So I would expect continued weakness in the housing market here. And if we have another 50 basis point rise before the end of the year, which most likely we will here in Canada, and the U.S. would be very similar, and also Europe, then that's going to cause even further pressure on the housing market, thus further hurting the consumer, thus further reducing the need to increase interest rates. Now, the worry is this, that if the banks around the world increase interest rates too much, too fast, too hard, they tip the economy into a major recession. And then we'll have to reverse course and start decreasing interest rates. If that happens, again, that would be a very positive for the stock market because the stock market loves cheap money. And also, it would be a very big positive for the real estate market because interest rates would be coming down all of a sudden. Because in North America, we still have a supply chain glut, supply chain issue when it comes to real estate. Now, last thing, again, getting back to the supply chain issue. A lot of the supply chain issue that was caused because of COVID, shipping issues, various people not coming back to work. All this is starting to unwind. And that will take a little bit more pressure off of inflation. But we're going to take a look at oil, supply chain, all that stuff combined, and a slowing consumer. Once inflation starts going down, that is finally when the stock market hopefully will receive that as positive and go and start heading in the positive direction. Hasn't done that in a long time, and the economy will finally start getting better once inflation's under control, and the Federal Reserve and the Bank of Canada and other banks around the world don't have to increase interest rates. In fact, can start lowering them. That will start spurring economic growth on again. Now, how long that'll take, we don't know, but this is what we're going to look at. All right, guys, hope you guys enjoyed today's video. Keep a lookout for those things. So if you're looking to buy a house, let's say, you know a couple more interest rates hikes are coming, and that pressure is going to be felt after those hikes. If you're looking to get in the stock market, you know that it's going to look forward 12 months roughly. If you think the worst is behind us, well, then there might be a lot of opportunity ahead. Anyways, hope you guys found that informative. Omar Khan here from Theta Trading. If you guys would like to book a call with us, we're going to put a link there. Also, if you want to check out our website, ThetaTradingCo.com, our strategy, you can look at our previous videos. Specifically, look at the one on naked puts. It is literally life-changing. Thanks a lot, guys. Take care and talk soon.